Okay, now we're going to talk about DD&A. And DD&A stands for depreciation, depletion, and amortization. Again, we're in the successful efforts method right now. We'll be learning full cost later. So in the successful efforts methods, we've spent a lot of time talking about what is going to be capitalized as an asset on the balance sheet versus what is going to be expensed on the income statement, like a dry hole, the exploratory well would be expensed on the income statement. So now we have these costs as assets on the balance sheet, and we've said that the cost center is a field. So we've collected these assets by the field, and now we need to start writing those assets off to match them against revenue. When we say write them off, that means take those assets and put them little by little as they're used up, right? Assets have future benefit, but they don't have future benefit forever. They're going to be used. These are assets that got us reserves. As we produce the reserves, the value of the remaining asset is going down because we have less reserve left. So as we produce the reserves, we should match the cost of getting the reserves, the wells and equipment, the capitalized costs, the signing bonus, and so forth. We should match those costs against the revenue we're getting from actually doing the producing. So DD&A is what we're going to be looking at right now, and that, again, depreciation, depletion, and amortization, or depletion, depreciation, and amortization, whichever D you want to put first. But basically, we do this by field on a units of production basis. So let's say we're producing a barrel of oil. Every time we produce a barrel of oil, we'll take part of that well and equipment cost from the field and match it against the barrel of oil, because that's what it costs us to get that barrel of oil in capital cost anyway. We have other kind of costs like production costs, but here we're talking about capital cost. So what does a basic DD&A formula look like? Just looking at a basic formula. Again, this kind of formula is not just used in the oil industry. Now here I have it as a reserve, so it kind of goes with the oil industry or oil and gas industry. But if I were a factory and I bought a major piece of factory equipment, very expensive, and through that equipment I could produce 1 million units. Then every time I produced a unit, I would take part of the cost of that factory equipment and put it to expense against the revenue I got from the unit. That's called matching. That's the basic thing we're doing. This is a basic DD&A, or units of production formula. What did I produce for the period? Now, normally a company is doing this on a monthly basis. Now, as far as the SEC is concerned, you have to do it at least quarterly, because you have to have quarterly filings if you're in the U.S. with the SEC. You also would have kind of an annual check before you do your 10K or your annual filing with the SEC. But internally, most companies are doing this on a monthly basis. So what was production for the period, whether that was a month or a quarter, divided by the estimated reserves I had before I started this period, before this month or quarter, what did I have left? How much of that did I produce? And that times the book value of my field is the amount that should be written off. Now, what is book value? Book value is what did I put in as assets, you know, the signing bonuses, the wells and equipment, minus any previous write-offs. When I write off to DD&A, something called DD&A expense goes to the income statement. That's matched against the revenue that I'm getting this period from my production. But we have something different that's going to the balance sheet to offset that. Remember, we have to be in balance. Assets equals liabilities plus owner's equity. So I've got an expense going to the income statement. To offset that, I have a kind of a negative asset. We call it a contra asset called accumulated DD&A. Accumulated DD&A is going to be a negative asset on your balance sheet. It shows up as a negative asset. And accumulated DD&A is going to be a negative asset, and it's going to reduce the book value of the field. So as the field is producing, the asset costs are units of production going to expense in the income statement, and they're decreasing the assets on the balance sheet through the use of this negative asset, accumulated DD&A. So what we're concerned today about, though, is how to compute the DD&A. Not necessarily how do we write a journal entry. Again, we're not writing journal entries in here, but how do we compute the DD&A? Okay, so this is what most companies will use, an equivalent formula. So you may have heard someone in your company talk about an amount of DD&A per barrel, or an amount of DD&A per MCF, or an amount of DD&A per BOE, barrel of oil equivalent, or OEB, oil equivalent barrel. How much did it cost me in capital cost to get this barrel of oil equivalent? So what I can do is take the book value of the field, and again, that's my everything I've capitalized minus any previous DD&A taken, minus accumulated DD&A, which is any previous DD&A taken. Divide that by my estimated reserves at the beginning of the period. That'll give me an amount per barrel or an amount per BOE. Every time I produce a BOE, then I'll just take that amount. So book value divided by my estimated reserves at the beginning of the period times production for the period is going to give me my DD&A amount for the period. Again, that DD&A amount will go to expense on the income statement, and it will reduce assets through increasing this negative asset called accumulated DD&A. So many companies will get an amount per BOE in each field, because you've got to do this by field, at the beginning of a period. So many companies say we'll do this on a quarterly basis. And then they'll say, you know, every quarter we go and we check to see if our amount is still accurate. For instance, if your reserves change a lot, that amount could be changed. So a lot of companies will get an amount per BOE. The amount stays the same unless there are major or significant reserve estimates. But they're really doing the same thing I'm going to be doing, showing you all the steps, except they're doing it by getting an amount per BOE. But it really, as we've seen mathematically, is the very same thing. Okay, so in the bottom, in the denominator of my equation, was estimated reserves at beginning of period. Well, what reserves? Now we've got differences between U.S. and international GAAP. Under U.S. GAAP, we would say, first of all, under U.S. GAAP, that we've got really two kinds of cost. We've got leasehold costs, that's our signing bonus type cost, and then we've got all our wells and equipment. And those two types of costs can be associated with different types of reserves. So for instance, we've got proved reserves, and remember our relationship. Proved reserves can equal, if the field's not developed yet, we're still going to have some PUDs, and we're going to have some proved developed reserves. So going back to their definition, proved reserves have a 90% or higher probability of being produced. The reserves that we can produce through the wells we've already drilled, existing wells and equipment, are proved developed reserves. We may still have to develop this field further, drill more development wells in order to get to the rest of those PUDs, or proved undeveloped reserves. And it's certainly common in many places in large fields that you're going to be producing while you still have PUDs. I mean, you're producing while you're still drilling. You've already started production, even though you haven't finished developing the field. So that's not uncommon. So if we look at leasehold, okay, leasehold, or the cost of getting a PSC, this is basically our property costs, our signing type bonus cost. Well, those costs can be associated with all the proved reserves we can get from that field. So leasehold, we say, under U.S. GAAP, is written off over proved reserves. However, wells and equipment, first of all, we're only going to use completed wells and equipment here. We're not going to use equipment in progress, or wells in progress. Wells and equipment, these are the wells we've already finished, and through those wells, we can only get to the producing developed reserves. So we say wells and equipment will be written off over proved developed reserves. As we drill more wells, the dollar amount in wells and equipment will go up, but also our PUDs will go down as they're being transferred to proved developed reserves. So over time, everything's going to be written off. Now, International GAAP is different. International GAAP does not separate out leasehold and wells and equipment. They add everything together as far as cost, and they write them off over, and this is how their wording is, but they write them off over either proved reserves or proved and probable. In the U.S., we cannot use probable reserves in a DD&A calculation. But in International GAAP, they can. They can use proved or proved and probable. Now, they have to be consistent. I can't change from year to year depending on how I want my DD&A to come out this year, right? Am I having a good year? Then I can take more DD&A, so I'll use just proved. We can't play those games. We have to be consistent. Now, as we get to International GAAP, we'll say, since we're using proved and probable, if we've got PUDs in this field, not only are we going to add our leasehold and our wells and equipment, but we're going to add our leasehold, our wells and equipment, and an estimated amount to develop those PUDs, because we're writing off over proved reserves, which includes the PUDs. So under International GAAP, we're including an estimated amount to produce those PUDs, which we'll get to as we look at the examples. Okay, so here's our first example, starting off easy. Successful efforts under U.S. GAAP. Exploration, Inc. drilled the first successful well on Block A early in 2014. And here's the data at the end of 14. We had a signing bonus on the books, capitalized at $80,000, wells and related equipment and facilities of $200,000. We still have to develop the field, and to develop the field, we expect to spend another $800,000. I know the amounts are low, but just take them as an example. Production, we just started producing. We had 6,000 barrels of production in 14. At the end of 14, the engineers say we have 900,000 barrels of proved reserves. We're going to say right now this is just liquids. Out of those, 100,000 barrels are proved developed. Remember, proved reserves equals proved undeveloped plus proved developed. So if proved reserves are 900,000 barrels and only 100,000 are developed, proved developed, then 800,000 of those reserves still need to be developed. We still need to do a lot more development drilling. We also have some probable reserves, 50% up to under 90% probability of being produced, 300,000 barrels. We will not use those under U.S. GAAP. So under U.S. GAAP, we can just kind of ignore those. But under U.S. GAAP, we're going to have two calculations for each field, one for leasehold and one for wells and equipment. The leasehold, again, we say can be associated with all the reserves that we can get. So leasehold, we're going to write off over proved reserves. Now, I could put the dollar amount in the numerator and the production over here and get the same amount. I can do a substitution, so whichever way you're more comfortable with. But in the example, I've got the production in the numerator. So production for the year or the month was 6,000. And at the end of the period, we've got 900,000 improved reserves. To get back to beginning of year, I'm going to add production to that 6,000. So because I want my estimated reserves at the beginning of the year. Let's talk about that for a minute, actually. If I'm at 12/31/14 and I want to know what my beginning of year reserves were, why don't I just use my 12/31/13 reserve report? Well, there's lots of reasons that's not a good idea. For one reason, this field wasn't even proved at 12/31/13, so there was no proved reserves. For another reason, though, even if the field had been proved at 13, at the end of 13, 12/31/13, even if we had a field that had been going for a while, things have changed. I've developed more wells. Some of my PUDs have become proved developed. But also, engineering is not an exact science. I think engineers are very, very smart people. But it's not an exact science. They make revisions. A year ago, they looked at everything that was happening in the field, in the reservoir, pressure and so forth, decline rates. maybe those changed a little differently than they thought they were going to change over the year. And so if they knew then what they know now at 12/31/14, gee, if I knew that at 12/31/13, I would have made different estimates. So the best way to get to the estimated beginning of period or beginning of year reserves is to take my reserves now. Okay, that's the best, using the best information the engineers have. Right now, we have 900,000 barrels in proved reserves. That's the best information we have. Well, if I add back what I produced to that, then that must be what I had at the beginning of the period, 906,000. So 6,000 was production over 906,000 before I started producing at the beginning of the period, times 80,000 in property costs is 530. That's my DD&A expense to the income statement, and that's going to reduce my leasehold asset on the balance sheet through accumulated DD&A on leasehold. I'm going to do the same kind of thing for equipment. My equipment here is 200,000. This is completed equipment only under U.S. GAAP. Except for equipment, I'm going to use only proved developed reserves, because through that one well I drilled, I can only get to my proved developed reserves of 100,000 barrels. So 6,000 is production over 100,000 in proved developed reserves. Right now, at the end of 14, if I produce 6,000 barrels, they had to be developed before I produced them. So that brings me to my beginning of period estimate. Before I started producing, I must have had 106,000 barrels in proved developed reserves. So I produced 6,000 of the 106,000 in proved developed reserves times 200,000 of my well cost. 11,321 is my DD&A. That's going to increase or go into the income statement as DD&A expense. Both of these amounts, 530 and 11,321, will be DD&A expense. And that they will both decrease my field asset, right? Leaseholds decreased by 530, wells and equipment's decreased by 11,321 on the balance sheet through the use of this negative asset called accumulated DD&A. Okay, now what if it's international? If it's international, we don't separate out leasehold. Everything's now in one pile. My leasehold was 80,000. My well that I had drilled was 200,000. That's 280 that I've spent. But now, because international writes off over proved or proved improbable, and it's going to cost more to get to those reserves. I haven't developed the field yet. I haven't finished developing the field yet. I've got to add in an estimate of my future development cost to finish developing the field, and that was 800,000. So now my total costs are $1,080,000. So just to show you that you could put the cost in the denominator, I flipped it this time. The cost can be in the numerator, $1,080,000. I could use total proved. Proved reserves are 900,000 barrels at the end of 14. Plus production to get back to beginning of year estimate. Before I started producing, I must have had 906,000 barrels times production of 6,000 barrels is 7152. So if I'm using proved reserve, 7152 under international GAAP is going to go to expense in my income statement, and it's going to reduce my assets in my balance sheet, again, through this negative asset accumulated DD&A. If I use proved and probable, everything's the same. My cost is still $1,080,000, but I'm adding in my probable reserves of 300,000 in the denominator. Again, I put the cost in the numerator, and I put production out to the side. So the numerator and production can be flipped. Either way, you're going to come up with 5373. So we'll see that if we use proved and probable, we're writing off less. Well, eventually, everything gets written off. Eventually, we have got to write off our cost. The idea here is that some of these probable reserves are going to be reclassified as proved. Okay. If we know we can't produce some of them, they need to come out eventually. So eventually, all of this $1,080,000 will need to be written off over the life of the field. If we're using proved reserves, we're writing more off in the beginning of the life or early in the life. If we're using proved and probable, we're pushing that back a little. So again, it's a management determination. and you must be consistent. But you can use either one. You can use proved or proved and probable. Proved and probable, again, is going to push back your DD&A a little further back in the life of the field. Okay, so let's do another example for lease A, where we already have been producing in prior years. So the balance sheet for Roberts Company as of 12/31/14 is as follows for Block A. I've got property cost, 110, less accumulated DD&A, because that is my contra asset or my negative asset. So I subtract that. My net property cost or net property asset is $90,000. I've got wells and related equipment of $2 million, less my negative asset of accumulated DD&A on these wells and equipment of $300,000. So my net wells and equipment asset is $1,007,000. Now in 2015 on lease A, I did some more things. First, I drilled an exploratory dry hole. Well, the field's proved. How can I drill an exploratory dry hole? It might have been to a different depth, than I've proved. So therefore, it was classified as exploratory. It's up here so we know what to do with it. If it was exploratory, and we're saying it was, so maybe it was going to a different depth, then that needs to be expensed on the income statement right away. It's going to go to the income statement as dry hole expense. This $300,000 will not go into your DD&A calculation. It could have also been in an area that you haven't proved yet. Sometimes if your field is large, you might have only proved part of your field. So it could be an area you haven't proved yet. I drilled a development dry hole. Well, development wells we know are always capitalized, so that is going to be included in DD&A. I installed some tanks and separators on the field. That's going to go in DD&A. That's wells and equipment. My future development cost, because I haven't finished developing the field fully, is $200,000. Again, we're only going to use that under international GAAP. Production was 100,000 barrels. My proved reserves at the end of 15, 1,020,000 barrels. Of those 1,020,000 barrels, 900,000 are proved developed. So the field's getting pretty close to being totally developed, but it's not quite. 900,000 out of 1,020,000 barrels are proved developed. And then I have some additional probable reserves of 200,000 barrels. Again, I will never use those under U.S. GAAP. So U.S., again, remember, U.S. is going to separate out leasehold and equipment separately. So we start with leasehold. Our leasehold, what is our net book value? We started with a net book value of $90,000, 110 minus 20 that we'd already written off. So that net book value is $90,000. Here I put production in the numerator, my proved reserves at the end of the year, because leasehold is associated with all proved reserves in the field. My proved reserves at the end of the year or end of the period are 1,020,000 plus 100,000 in production to get back to beginning of period. So 100 over 1,120,000 times 90,000 is 8,036. For wells and equipment, I started with 1,007,000. That was my wells and equipment minus accumulated DD&A. I had a development dry hole. That's going to get added in. I had tanks and separators. That gets added in. Again, the only thing that's not added in is that exploratory dry hole, because that's going to the income statement as expense. So my costs are $2,125,000. They're getting written off over only proved developed reserves. So 100,000 was my production over ending proved developed reserves of 900,000 plus 100,000 to get back to beginning of period. So 100,000 over a million times 2,125,000 is 212,500. Again, in each of these cases, these amounts will go to expense in the income statement, and they're going to reduce our asset. Our leasehold asset will be reduced going into next year by 8,036. Our wells and equipment asset will be reduced by 212,500 through this accumulated DD&A. Internationally, again, I add everything together. So I had equipment on the last slide of 2,125,000. I had property of 90. Those are going to get added together. But because I had not fully developed the field yet, I also have to add in those future development costs, that estimate of 200,000. So my total cost is $2,415,000. I'm going to write that off over total proved or proved and probable. Using proved, 100,000 in production, over proved, end of year, 1,020,000 plus 100,000 in production to get back to beginning of year, times 2,415,000 is 215,625. Using proved and probable, the difference is I'm going to add in that additional probable of 200,000 barrels in the denominator. And now my DD&A is only 182,954. Again, I'm writing off a little slower, pushing those capital costs out more before they get expensed. They will all eventually be expensed. They have to before the end of the life of the field. But if I'm including probable reserves, I'm just pushing some of that expense back to later years in the life of the field. Okay, now we've talked about, or my examples have been liquids. So what do we do when both oil and gas are produced? Well, for the most part, we go to a common energy unit. It's common in the U.S. that we see a rate of 1 barrel equals 6 MCFs. Now, there's nothing overly magic about that, except that it is a rate that the IRS tends to use in their rules. Now, I'm going to tell you, the DD&A that we're doing here is not what goes in your tax return. There is a whole different system for tax accounting. If any of you are in tax accounting, you know that. So this DD&A is not what's going on in your tax return, but nonetheless, it tends to be kind of a norm that because the IRS, the Treasury Department, uses a 1-to-6 ratio, a lot of U.S. companies tend to use it. So what we're trying to come up with is an equivalent energy unit. So we're saying here that about 1 barrel of oil equals the same amount of energy as about 6 MCFs, or 6,000 cubic feet of gas. That's all we're saying. The 1 barrel of oil equals 6 MCFs of gas. Now, we know that oil, depending on where it's being produced, can be a very different quality, right? Oil in Africa is different than the quality of Brent, which is different than the quality of West Texas Intermediate. So you don't have to use this 1-to-6. You know, you might have to in your tax return, but you don't have to for financial reporting. Many U.S. companies do, but you do not have to. I've heard of companies that have done it by field or by region, so that in one region they might have a 1 equals 5.79. In another region, they might have a 1 equals 6.13. When I was doing training for Eni, the Italian company, I know the last year I was there, they had as a company overall 1 barrel equaled 5.76 MCFs. So what they were saying is, as a corporation, on average, 1 barrel of oil equals about 5.76 MCFs of gas, on average, based on the quality of the oil we're producing. But we basically use a 1-to-6. Now, if either oil or gas is really insignificant, then you could ignore that. But there's not a necessarily strict line on what's significant. So if I'm producing 95% oil and 5% gas, I feel like it's pretty insignificant. I could just ignore the gas amount, just use the barrels. It's not going to make a big difference in your ratio. But if I'm producing 25% gas and 80% oil, that sounds much more significant. And now I need to use this, I need to come up with this common energy unit, or a BOE. I tend to refer to it as BOE, barrel of oil equivalent. Some companies call it oil equivalent barrel. Or if you're a company that deals mainly in gas, which a lot of companies, especially in the U.S., do, you can go to your equivalent MCFs or BCFs or even TCFs, depending on how big you are. So you can go the other way. So what we're going to do to go to barrel of oil equivalents is we're going to take our MCFs, divide by 6, and that's our equivalent barrels. Okay, so let's start looking at a few exceptions. And this one is pretty common. In the U.S. is where you're going to find this one. If significant development costs are incurred before all proved reserves become developed, means we still have some PUDs, then we exclude the portion of the development cost attributable to the undeveloped proved reserves, or to the PUDs. Okay, so what does that mean? Well, where you're going to see that commonly is offshore, or I'm saying pretty commonly. You could definitely see it other places, but I'll give you that as a common example. Let's say I'm offshore, deep water, Gulf of Mexico. I've got a large field. I'm going to be drilling lots of wells, but I'm already producing while I'm still drilling. I still haven't finished developing the field because there's lots there. I've already started producing, but I'm still drilling development wells. Now, before I could start producing, though, I had to build this huge production facility out in the Gulf of Mexico, and I had to build flow lines to bring all that production into the refineries, right, off of South Louisiana. That cost many, many, many millions of dollars. Well, remember what we're doing here, right? We're saying we have wells and equipment. Okay, we have wells and equipment. That would include the cost of that huge production facility and those flow lines. And we're writing these costs off over only proved developed reserves. Well, aren't all the proved reserves going to go through the same production facility? They sure are, so that doesn't seem to make sense. If I haven't developed all my reserves yet, I'm not doing a good matching. I'm taking a huge amount of wells and equipment and writing them off over a relatively smaller number of reserves than those wells and equipment are actually going to be able to produce as far as this platform is concerned. In other words, I've got this platform, maybe I've drilled 20 wells, but I'm going to drill 80 in total. Why am I writing all of this platform cost off over the proved developed reserves from just those 20 wells? That doesn't make sense. I'm not doing a good matching. I'm having a lot of DD&A up front. I'm going to have a very bad looking income statement, but it's not really matching my revenue and my expense or the way I'm using my assets. So what we're going to do to take care of that is we can do a couple of things. And the first thing is called a slot basis. It's very simple to use. Slot basis. So here's my example. We have a production platform. We constructed at a cost of $4 million. We've drilled 15 wells in this area, but we plan to drill a total of 60. So we have not drilled 45 wells yet, so we exclude 45/60ths of the $4 million from our DD&A calculation. Just exclude it. That's $3 million. Or we're going to include 15/60ths or $1 million. Now you might say, why wouldn't you just say go ahead and include 15/60ths or $1 million? Well, the reason is it's because the way the statement is written, it's written in such a way as that it talks about the computation of your exclusion. So this is what the auditors look at, your exclusion computation. I've talked to many companies who say, yeah, internally we're just going to say, yeah, we're going to include 15/60ths. I mean, obviously. But when the auditors come, we have to show the exclusion computation, which is the 45/60ths of $4 million that was excluded, because that's how the statement talks about it. The statement talks about making an exclusion. So in this case, I've got a platform that costs $4 million. 15 wells have been drilled, but I plan to drill 60. So 45 of the 60 have not been drilled. 45/60ths of the $4 million is excluded from my DD&A calculation. So when I add up my costs, I'm just going to take $3 million out. Now, every time I drill a well, right, this number goes down. I drill another well, now only 44/60ths are excluded. After another one, now only 43/60ths and 42 and 40, until eventually I've finished drilling. Eventually, all of this cost will go into my DD&A calculation, but it's going to kind of go into there one well at a time, right? As I finish drilling, then the next time I do DD&A, I'm going to have 44/60ths, and that's going to keep going until all my wells are drilled. So eventually, all the costs will be in DD&A and will be written off. Now, that basis assumes that every well produces the same amount. In reality, that's probably not true, but it is per gap. You can do that. Now, if you want to be a little bit more precise, you can use a reserves basis of doing this. So that was a slot basis, depending on the number of wells or number of slots. This is a reserves basis. So we've got the same production platform. We already constructed it. It cost $4 million. Our proved reserves are 15 million barrels. Out of those, we have proved developed reserves of 5 million. So that means we have 10 million in PUDs, right? If our proved reserves are 15 million barrels and our proved developed reserves are 5 million barrels, then our PUDs are 10 million barrels. So we're going to exclude 10 million over 15 million of proved reserves, 10 of the 15 million. It's not yet developed, so we're going to exclude 10/15ths of the 4 million, or 2,666,667, or we're going to include 5/15ths, or 1/3, or 1,333,333. This is acceptable also, even though it doesn't come out exactly the same. This is certainly an acceptable, it's probably a little bit more precise way of doing it. Again, this difference is going to get smaller and smaller and smaller, right? Because as I drill more wells, my proved developed reserves are going to go up and up and up until I have finished drilling. Once I've finished drilling, I no longer have any PUDs, and the total cost goes in. The entire cost will eventually be written off. So we can either do it on a slot basis or on a reserves basis. Now, this is not a problem under international GAAP. Let's see, let me go back to this one. This is not a problem under international GAAP. And why? Because international GAAP took leasehold plus wells and equipment. Write international here. Plus my future development cost. Right, what's it going to cost me to finish developing? And they wrote all of that off over proved or proved plus probable. So in other words, this is not an issue in international GAAP because we're not writing equipment cost off over just proved developed reserves like we are in the U.S. Right, this is an issue in the U.S. because our equipment cost, including that platform, are getting written off or being written off over proved developed reserves. This is not an issue internationally, so there's no adjustment internationally because that wells and equipment, the wells and equipment, including the platform, also the leasehold, also the future development costs, they're all getting bunched together and getting written off over proved or proved and probable. So there's no adjustment to make. We're already writing them off over all the reserves. Okay, the next exception, though, this one we will have an exception internationally. It may not happen as often, but it certainly can happen. If we're in a field that's fully developed, this field has all proved developed reserves. There are no PUDs. This field's fully developed. And it has been producing for a number of years. And now we see the decline rates are going maybe a little differently than we expected. And the engineers, certainly not the accountants, the engineers determined that there needs to be an improved recovery project before we can get to all of our reserves. So, under U.S. GAAP, if proved developed reserves can be produced, even though they're already classified as proved developed reserves, we're now being told they can be produced only after an improved recovery system is constructed. Then we're going to exclude the proved developed reserves associated with the cost that have not yet been incurred. So in other words, exclude the amount of reserves I can't get to until I've done that project. Once I've done that project, add the reserves back in. Internationally, they're doing the opposite thing, though. They have a problem, but they're doing the opposite, they're saying. They're saying, okay, we've got some proved developed reserves that can be produced only after an improved recovery system is constructed. So let's leave all the reserves in our DD&A calculation, but now include an estimate of that project in our future development costs. Include that as your future development cost. So don't take out any reserves internationally. Instead, keep the reserves in and add an estimate of the cost. So in the U.S., we're saying take the reserves out of the denominator, take the reserves out that we can't get to yet until we've done the project, then add the reserves back to the denominator. Internationally, they're saying, no, let's leave all the reserves in the denominator, but when we do the cost, add in an estimate of the cost. So if we look at these examples, let's say we have a gas injection project that's going to cost $3 million. Proved developed reserves in this field are 1,200,000 barrels, but the engineers tell us that 500,000 of those barrels cannot be produced until after the project is completed. In the U.S., we would exclude those 500,000 barrels of proved developed reserves when we do depletion. Now, we would exclude that until the project is completed. Then we'd put the 500,000 barrels back in the denominator. But internationally, they would include all proved reserves or proved and probable, if they're being consistent and they're always using proved and probable. They'd include all those reserves, but they would include the $3 million estimated cost of the project in the calculation. So they would include all reserves, but add in an estimate of the cost when they do DD&A. We would not add an estimate of the cost when doing DD&A, but instead we would exclude 500,000 barrels of proved developed reserves. Once the costs have been spent, and those costs then are in DD&A because they've now been spent, then the reserves come back in to the computation. Okay, so what about support equipment? This is a very simple example, but often you have, just to let you know how this works, right? You often have equipment that you're using on more than one field. And under successful efforts, we're doing DD&A by field. So what do? You know, we're up in North Dakota, and we've got several fields up there, let's say. And we've got a truck that's being used on different fields. What do we do with this? Here's the idea. On this one, I've got seismic equipment. Generally, what we're going to do, we can't put that in a DD&A calculation because it's being used in more than one field. We're going to take straight line depreciation. That means basically for our purposes, if something has a 10-year life, then write off 1/10 of the cost each year. Okay, we're going to be pretty easy. Now, you do take out salvage value. So let's say something has I paid $100,000 for it. I expect to get $10,000 for it when I'm finished using it. Then my net cost, net of salvage, is $90,000. If I expect to get $10,000 back when I'm finished using it and I paid $100,000. So I'd take $90,000 divided by 10 years and $9,000 in depreciation a year. So again, I'm making it pretty easy here because I'm giving you a lot of this information. I just really want you to know how this works on support equipment. Peters has seismic equipment, so they're, instead of using a contractor, they're doing their own seismic. It was used only on Block A in 2000A. Depreciation on the equipment was $8,000 for the year, and operating cost was $10,000. Well, the idea here is, and again, I've got these as journal entries, but instead of this being depreciation expense, it's going to be G&G expense. It's going to be G&G expense because it was used to get G&G. And in the U.S., this is U.S., let's say in the U.S., I've got U.S. here, we're going to expense G&G. So that $8,000 ends up as an expense on the income statement. Then the truck is going to have accumulated depreciation on the truck. Again, that's going to bring down the value of the asset of the truck on the balance sheet. But we're going to have G&G expense instead of depreciation expense. That's the main point I'm trying to get to here. And the $10,000 in operating cost is going to go to G&G expense instead of operating expense because it was used to get G&G. And then maybe the asset cash may be decreased or the liability payable increased. Okay, partial abandonment is pretty consistent between the U.S. and internationally. What happens if I've only abandoned part of a field? So again, I've got a field, it's got a long life, it's got several years of life left, but I started drilling some wells quite a while ago, even though I'm still drilling new wells. I started drilling and producing quite a while ago. Well, those wells that first started producing, the first wells that started producing are now being depleted. But the field's still going on. So we call this a partial abandonment. Then only part of the field is abandoned, in this case a well. It's treated as fully amortized and charged to accumulated DD&A. Now, I know this, I've got an entry here, but we can look what it is. Let's say I had a well that cost $100,000. That well is now being abandoned, but the field still has other wells. Then that well is going to come off of my assets. So my assets, wells, and equipment are going to be reduced by $100,000 because that well is being abandoned. It's being plugged. I'm going to take that well out of my assets. But what I'm going to do instead is add that, what I'm going to do instead is charge that well against my contra asset. Now, remember, as I take DD&A each year, DD&A expense goes to the income statement, and then I decrease my asset by using this accumulated DD&A account. Now that this well has been fully used up, the well is going to come off of my balance sheet, but the accumulated DD&A that was put in for that well is also going to come off of my balance sheet. So both of these, this is decreasing an asset, and this is decreasing a contra asset. So I'm decreasing an asset and decreasing a contra asset by the same amount. So again, what I've got here, don't let this confuse you. What I've got here is a well on my books of $100,000. And then I've got accumulated DD&A. Remember, accumulated DD&A is a negative amount of $100,000. Okay. Now this well is now being abandoned. So what's happening is I'm taking this asset off, but I'm also taking this contra or negative asset off. So all I'm doing, what I'm saying is writing off a fully depreciated asset. So the well, the asset, wells and equipment is reduced, but the contra asset or the accumulated DD&A that reduces assets, that's also reduced. Now, I can't go back and prove that I put exactly $100,000 of DD&A in accumulated DD&A for that well. I can't prove that because I don't do accumulated DD&A by well. I do it by the field. So it is a GAAP assumption, both U.S. and internationally. It is a GAAP assumption. It's a basic assumption. The assumption is if my engineers have been giving me good reserve estimates, then as this well was being used, the well cost should have been written off to DD&A expense. As it was being written off to DD&A expense, accumulated DD&A, which is our contra asset or our negative asset, was going up. So when I'm retiring the well comes off the books, but the contra asset also comes off the books for the same amount. All I've done is written off a fully depreciated asset. I've reduced an asset, I've reduced a contra asset. My book value of the field has changed by 0. An asset has been reduced, but a contra asset, something that reduces an asset, has also been reduced. So my net book value has changed by 0. All I did was write off a fully depreciated asset. So the book value is the same before I write off this well as after I write off the well. Right, assuming again, the well's been producing for a number of years. I've got the well and wells and equipment at $100,000 that comes off. I've got my contra asset or my negative asset, accumulated DD&A. We're going to assume there's $100,000 in there because those costs were written off as this well produced, and that comes off. So the net book value was changed by 0. Okay, and with that, I will agree that, this is a pretty tough topic. Read the portfolio, look back over the lecture again, and then work as hard as you can on those assignments and quizzes.